In modern societies, the progressive income tax is the method of taxation used for the government to generate revenue. The general concept of this system of taxation is that high-income earners are taxed more than low-income earners. In other words, the more money ones make, the more taxed that person. The purpose of this system is to reduce income and wealth inequality across society, to make society fairer on economic grounds. This system is pretty much implemented everywhere across the world, especially in Western countries. In this United States, this system of taxation has been implemented as a permanent fixture of the tax federal system since 1913, when Woodrow Wilson, a progressive politician and academic with socialistic leanings, was President of the United States. It was implemented with the ratification of the 16th Amendment. This amendment allowed U.S. Congress to levy an income tax on individuals without apportioning it among the states. Shortly after, the Revenue Act of 1913 was enacted, establishing a 1% tax on incomes above $3,000, with a top rate of 6% on incomes over $500,000. While the modern progressive tax officially began in 1913, earlier versions existed during national crisis. As a matter of fact, the progressive income tax was established for the very first time in American society by the Revenue Act of 1862 during the Civil War. Congress passed the first federal income tax law in 1862 to help fund the Civil War effort. This was a progressive tax that applied different rates to different income levels, but it was later repealed in 1872. The act was signed into law by President Abraham Lincoln and replaced the Revenue Act of 1861, which had imposed a flat income tax of 3% on annual incomes above $800. The progressive income tax implemented in 1862 imposed a tax of 3% on incomes between $600 and $10,000 and a 5% tax on incomes over $10,000. In 1894, an income tax provision was included in the Wilson-Gorman Tariff Act, but the Supreme Court ruled it unconstitutional the following year because it was considered a direct tax that was not apportioned by state population. In fact, the act imposed a flat tax of 2% on all personal income over $4,000, as well as a 2% tax on corporate income above operating expenses. The high exemption threshold meant that the tax affected fewer than 10% of households, effectively targeting only the wealthiest Americans. The main goal was to compensate for the reduction in federal revenue resulting from the lowering of protective tariffs, which had been a key Democratic platform promise. The provision was a quote-unquote measure supported by agrarian and progressive groups who believed the wealthy were not paying their fair share under the existing tariff regime, which tended to burden lower-income individuals through consumption taxes. The income tax faced immediate legal challenges and was struck down by the Supreme Court in a controversial 5-4 decision in Pollock v. Farmers Loan and Trust Company, 1895. The U.S. Constitution, Article 1, Section 9, requires that direct taxes be apportioned among the states based on population. The central question was whether an income tax constituted a direct or an indirect tax. Indeed, the court ruled that a tax on income derived from property, such as rents, dividends, and interest from stocks and bonds, was, in effect, a direct tax on the property itself. Because the tax was not apportioned among the states according to population, it was declared unconstitutional. The decision was widely unpopular among progressives and populists, who saw it as a victory for the moneyed class and a surrender of Congress's taxing power. It essentially halted the federal government's ability to levy an income tax for nearly 2 decades. The invalidation of the 1894 income tax galvanized the push for a constitutional amendment to explicitly grant Congress the power to tax incomes without apportionment. This effort culminated in the ratification of the 16th Amendment in February 1913, which provides that Congress can lay and collect taxes on incomes from whatever source derived without apportionment among the several states. The 1894 provision, though a failure in its time, laid the groundwork for the modern U.S. income tax system. Post-1913, the tax was initially a, quote, class tax, affecting only a small percentage of the population. During World War I and II, the rates and number of people paying taxes increased dramatically, transforming it into a mass tax. The top marginal tax rate reached as high as 94% during World War II, from 1944 through 1963. Progressive income taxes are designed to impose higher rates on higher earners, with the goal of redistributing wealth and reducing income inequality by funding public services and transfers that benefit lower-income groups. However, empirical evidence and economic analyses suggest they often fall short of significantly narrowing inequality gaps. First and foremost, income inequality is largely driven by pre-tax factors. Indeed, much of modern income inequality stems from market dynamics before taxes are applied, such as wage disparities, access to education, technological changes, globalization, and asset ownership. Progressive taxes can only redistribute after the fact. They don't address root causes like skill-biased technological change or concentrated corporate power that widen pre-tax income gaps. For instance, in the U.S., pre-tax inequality has risen sharply since the 1980s due to these forces. And while taxes mitigate some of it, the overall effect on post-tax inequality remains limited, as federal taxes have shrunk relative to income over time. Similarly, Europe's lower inequality compared to the U.S. is more attributable to pre-distribution policies, for example, stronger unions, education systems, than to tax progressivity alone. Second, the progressive income tax shapes behavioral responses, which triggers tax avoidance by high earners. High-income individuals often respond to progressive rates by reducing taxable income through legal avoidance, e.g., shifting income to capital gains, which are taxed at lower rates, offshore accounts, or reduced work effort. This diminishes the revenue raised and the redistributive impact. Economic models show that increasing progressivity can lead to modest or even counterproductive effects on inequality if top earners adjust their behavior, such as by investing less or relocating. In Argentina, a progressive property tax reform revealed that compliance dropped among those perceiving the system as unfair, underscoring how taxpayer morale influences outcomes. Critics argue this creates a, quote, class ceiling, where progressive brackets discourage upward mobility, as seen in anecdotes of people declining promotions to avoid higher tax bands. Third, the progressive income tax doesn't work because it focuses on labor income and ignores capital and wealth concentration. Progressive income taxes primarily target earned income, wages, but much inequality arises from unearned income, like capital gains, dividends, and inheritance, which are often taxed lightly or deferred. For example, billionaires' wealth grows through asset appreciation that's not taxed until realized, eroding progressivity. Studies of wealth taxes in Switzerland show that even progressive systems have limited impact on top wealth shares because capital gains remain favorably treated. This is compounded by corporate profit shifting to shareholders rather than workers, a trend unchanged by tax reforms. As a result, raising income tax rates on the rich yields only modest reductions in overall inequality. Fourth, the progressive income tax produces unintended economic effects and growth trade-offs. Nobel Prize-winning economist Friedrich von Hayek vocalized his fierce disagreement with the progressive income tax. In point of fact, he viewed the implementation of progressive tax systems as incompatible with the principles of an open and liberal society. He argued that the imposition of higher taxes on higher incomes creates a bias against economic wealth and negatively impacts the incentives of the working age. His thought stems from philosophical and moral theories. Hayek believed that fiscal problems are partly to its foundations in moral philosophy practiced by society. Progressive tax prohibits the incentives of free market competition, whilst the wealth of the minority is subordinated to the democratic vote of a majority. This results in illegitimate transfers of political power. Some research indicates that highly progressive taxes can slow economic growth by disincentivizing investment and innovation, potentially increasing long-term inequality. Simulations show that tax cuts with fixed progressivity boost growth but widen gaps, while ramping up progressivity might reduce both growth and inequality mildly, but the trade-off favors inequality persistence. Empirical studies, like those on U.S. states, find that greater progressivity can actually increase income inequality by altering labor supply or capital allocation. In Eastern Europe and Central Asia, switching between flat and progressive systems didn't always yield expected inequality reductions due to informality, evasion, and macroeconomic factors. Thus, what is the solution to make society fairer? A flat tax system applies a single tax rate to all taxable income, regardless of earnings level. First, flat taxes treat everyone the same rules, same rate. This embodies equal protection or fairness in process. No punishment for success via higher rates, no favoritism through loopholes that benefit the wealthy or connected. Progressive systems create classes of taxpayers, where higher earners face rates up to 37% federally in the U.S., plus state taxes. This can feel like penalizing productivity. A flat tax eliminates that distortion, making the system neutral and transparent. Evidence from implementations. Countries like Estonia, 20% flat rate since 1994, Russia, 13% since 2001, and others, e.g., Bulgaria 10%, Hungary 15%, have seen revenue stability or increases, partly due to better compliance and reduced evasion. Russia's personal income tax revenue rose significantly in the years following adoption, attributed to simplicity encouraging reporting. Second, it creates simplicity, and this simplicity leads to a reduction of corruption and inequality from loopholes. Current progressive systems are complex, thousands of pages in the U.S. tax code, breeding deductions, credits, and shelters that disproportionately benefit high-income individuals with access to accountants and lobbyists. This creates de facto unfairness. The ultra-wealthy often pay lower effective rates than middle-class workers. A flat tax strips most loopholes, broadening the base and lowering the rate while raising similar revenue. Tax filing becomes postcard simple, reducing compliance costs, estimated at billions annually in the U.S., and minimizing opportunities for elite manipulation. This levels the playing field more effectively than progressive rates on paper. Third, and more importantly, a flat tax creates economic incentives for growth that benefits everyone. Flat taxes remove disincentives to earn more. No tax bracket penalty, discouraging overtime, investment, or entrepreneurship. Proponents argue this boosts overall growth, raising wages and opportunities for lower earners indirectly. Studies on flat tax adopters, e.g., Eastern Europe post-1990s, show correlations with higher GDP growth and investment, though causation is debated. Other reforms often coincided. Still, the predictability appeals in a global economy where capital flees high, complex taxes. Critics counter that flat taxes are regressive in impact. Same rate means low earners pay a higher share of disposable income due to essentials taking larger portions of their budgets, diminishing marginal utility of money. Progressive systems better match ability to pay, reducing inequality directly. Ultimately, no system is perfectly fair, but a flat tax's transparency and neutrality make it a pragmatic reform for reducing arbitrary distortions in society. If the goal is fairness through equal rules and incentives, rather than engineered outcomes, it's arguably the most straightforward and achievable option.